What if I told you that your house, probably your biggest investment, isn't actually an asset at all? In fact, most wealthy people wouldn't consider their homes an asset. Today, I'm going to show you what the truly wealthy invest their money in instead, and how understanding this one concept can completely change your financial future. Hey everyone, I'm Elias, and my path to financial freedom started a bit earlier than most. At just 20 years old, I bought my first rental property. That was a decision that completely changed the trajectory of my life. Within another year, I bought additional properties, and just through the rental income that I was collecting every month, I was able to retire and effectively not need to work by the time I was 21 years old. Today, I acquire and grow companies. I've since moved on from real estate investing, and I also teach and train people about how you could achieve the same level of success. I believe that most people's conventional understanding of wealth building is completely flawed. But before we dive in, let me tell you something that might surprise you. Conventional wisdom on wealth building is fundamentally flawed. Let me explain why and show you what actually works. The easiest way to explain this concept is the idea of an unproductive asset versus a productive asset. So what do I mean by productive asset? Well, as the name suggests, a productive asset is an asset that produces something, generally cash flow. An unproductive asset is an asset that doesn't produce anything. So to give you an example, something like an unproductive asset would be a Picasso painting, or a watch, or a gold. Fundamentally, you could consider them assets, but they don't produce anything. A productive asset is something like a business that generates income, a stock that might pay a dividend, a rental property where you get paid rent, or even a farm. You might get income from a tenant farmer, or you might have corn and soybean and dairy products. It's an asset that fundamentally produces something. And I'll explain why understanding this difference is super important. To truly build wealth, you need to focus on acquiring productive assets. And the reason I said in the beginning of this video that your house probably isn't an asset is because your primary residence, at the very least, is not actually producing anything for you, right? Yes, you pay a mortgage, you have equity that you're building up. It's your home, right? And the home might even appreciate. But fundamentally, when you get down to it, is that home putting money in your pocket every month, or is it costing you money every month? To really build wealth, you want to accumulate assets which put money into your pocket every month, grow your income, and they grow your balance sheet, and they grow your earnings. This is actually also the reason that the first home I bought, I ended up getting 2 or 3 roommates to pay my mortgage. I did house hacking. I was 20 years old. I was completely fine. I was completely willing to do that. I had friends that were interested in living with me, and I collected rent from them, and I was able to actually completely pay my mortgage. So I basically had a free home, and I was building equity, and I was actually pocketing a little bit of money every month. When you buy unproductive assets, similar to cryptocurrency, which is the flavor of the day, whether you're buying gold or silver or commodities or whatever that may be, the fundamental proposition there is you're buying that thinking, hoping, praying that some bigger idiot is going to come along and pay more for it than you did. If you could buy all of the Bitcoin in the world, but you can never sell it, what's it going to do for you? Would you buy it if you could never sell it? No, obviously it's worthless. You can't do anything with it. But if somebody offered you all of the farmland in the world, but you can never sell it, would you take that deal? Absolutely. Yeah, you might not be able to sell the farm, but you'll have all the corn and the soybeans and the produce and the dairy products and the poultry and potentially even the income if you have a tenant farmer. You might even be able to rent some of the property out for a fairground. I mean, there's all kinds of ways you could use that property to produce something. But if you had all the gold in the world, you could look at it, you could fondle it, you could touch it, but it's not going to do anything. Your only proposition is you're hoping some bigger idiot is going to come by and pay more for it. But there's a lot of instances where valuations go down. And I'll actually need to correct myself. Technically speaking, if an asset does not produce cash flow, it cannot be valued, only priced. You could price a Picasso painting, but you cannot value it. You could value a business. You could value a rental property. You could value a farm, something that generates cash flow. You could assign a value to it. But anything other than that, if you're buying a painting or a watch or whatever, you're fundamentally speculating because you're betting that somebody else is willing to pay more for it. And so there's a reason why Warren Buffett is very outspoken about this. He believes in obviously not speculation, which is very akin to gambling. He believes in fundamentally buying assets that produce inherent value. There's also another reason why I buy businesses, right? The businesses that I acquire have value because of the cash flow they generate, But the beauty is when you buy a company completely and not just the stock, which is fundamentally just a piece of a business, when you buy the whole business, you could control the business. And I could control the cash flow. And I could grow the revenue. And I could grow the earnings. And I could make the business more profitable. That's how people build wealth. When you see people like Elon Musk or Bill Gates or Jeff Bezos or all these wealthy people, they have very concentrated net worths in the businesses that they owned, that they grow. They were able to grow the revenues and the earnings of the business, which fundamentally drove up the valuations of those businesses. They own very productive assets. They didn't get rich with crypto. They didn't get rich speculating that a stock might go up. They built and bought businesses that had inherent value. Another reason why productive assets are so incredibly powerful to acquire is you have the advantage of compound interest. There's a reason that Albert Einstein called compound interest the sixth wonder of the world. It's, mind-boggling when you look at the numbers. So, say you're 20 years old, and say you got hired at a company and you were given a $10,000 sign-up bonus. Well, you could do what most 20-year-olds do and just waste that money away and waste it on shit you don't need. Or you could pretend that money didn't ever come in and throw it in the stock market. And you could do, if you follow the most conventional wisdom, which is fairly decent advice, but the most conventional advice, to just slap that money in an index, S&P 500 index fund. And if you don't know what that is, the S&P 500 is basically a collection of the 500 largest companies in the United States. And you're basically buying a slice of American business. And over the last 30 years, if you're not counting for inflation, the S&P 500 grown about 10% year over year for the last 30 years. So if you put that $10,000 into a S&P 500 index fund, and it grows for 10% a year, say you forgot about it. You completely forgot about it, and most people retire at 65, so you got from 20 to 65, that's 45 years, growing at 10% every year. That $10,000 would end up turning into $729,000 without you doing anything. And if you really want to take it a step further, say you're smart enough to shovel away $500 a month, right? That's not much, $500 a month. So you had the 10,000, you added $500 every month, just on autopilot, you just put it away in your savings. That $729,000 all of a sudden now becomes over $5 million without you doing a damn thing. That's compound interest. In many particular cases, if you have a brokerage account, they actually have programs that even help you take advantage of compound interest. In many cases, they call it DRIPs, dividend reinvestment plan. So if you own stocks and they pay a dividend, they could automatically take that cash that you get paid out and reinvest it to buy more stock and buy more and buy more. And every quarter, every year, the business continues to generate cash. They pay you a dividend. You then take those earnings, buy more of their stock. Their stock continues to appreciate. So not only do you have the benefits of getting a cash flow stream from the dividends, but then you have appreciation of the stock, and that compounds and compounds and compounds. And over the course of decades, it's scary to know how much money you could build. If you're a complete idiot, there's no reason you shouldn't die a multimillionaire just by stacking away a little bit of cash, slapping it in an index fund, and turning your brain off and pretending it doesn't exist. You also have a natural protection against inflation. Generally speaking, assets that generate cash flow have a natural hedge against inflation, right? Generally speaking, you might have 2, 3, 4% inflation every year, and that just kills away your savings. It destroys the buying power of a dollar. But if you own a rental property and you have inflation of 3%, I could increase my rental cost by 3%. I can naturally hedge against inflation. Not only that, but my housing prices go up. Same thing if I own a business. I could increase the pricing of my services. I could charge more for my product. I can naturally hedge against inflation. What are you going to do with gold? You can't do anything with it, right? If you have commodities, what are you going to do? But if you have assets that generate cash flow, you could hedge against inflation because generally speaking, the value of those go up. And then also the cash flow that actually gets generated, you could adjust your costs for inflation. So you're naturally protected. You also have tax benefits, tax advantages to buying productive assets. Again, going back to the example of an apartment house, you buy a property, you could then depreciate the value of that asset over 27 and a half years. So you might be making profit every month off your rental income, but then you offset it with your depreciation. On paper, it might look like you're losing money and you don't have to pay taxes. Or you could significantly reduce your tax liability, even though you're making profit every month. Again, the tax code is there to incentivize you. And there's nothing greater than probably the advantages that real estate gives you. It's a totally different story when you're looking at something like a commodity versus a cash flowing business or any type of asset that really produces something. And one of my personal favorite advantages, this thing to me knocks the socks off of any commodity is you have the ability to leverage productive assets. Banks are not really keen on lending you money to go buy painting or to buy gold or precious metal. I mean, anything. If it doesn't generate cash, a bank is not generally very keen on lending you money to go buy it. But if you're buying a productive asset, again, whether it's a farm, which actually the federal government has programs specifically to help you buy farms, or if you're buying a rental house, or you're buying a business, or you're buying anything that really generates cash, almost always there's some type of loan product out there where banks are willing to give you money to go buy it. And the beautiful thing about that is they're willing to do that because the business itself, the cash flow that that business or asset generates, will pay off and cover the debt service. And that increases your buying power ultimately. I mean, again, I was 20 years old when I bought my first house. I wouldn't have not been able to pay. I paid $380,000 for that house. I wouldn't have been able to pay all cash for that. I was 20 years old. But I was able to put 20% down, and the bank gave me 80%. Okay, but I had, a mortgage I had to pay every month, but then I had roommates, and they paid for my mortgage. So I was able to buy a $380,000 asset for basically no money out of pocket other than my down payment, which obviously that's equity, you didn't lose that. And then that debt service that I had every month was paid for by my tenants. Then when I ultimately sold the house, I sold it for $520, so I made a pretty nice profit on that. I was 20 years old. I wouldn't have been able to pay that in all cash. But again, banks are there for a reason. When I buy businesses, again, I look for a business that has cash flow. I buy it for a multiple of that cash flow. And then the SBA, for example, a fucking license to steal. They'll give you 90% of the purchase price, in some cases 100%. You could buy a company that generates cash for little to no money out of your pocket, and the cash flow that the business generates pays for the debt. That's a fucking no-brainer. They just allow you to continue to accumulate assets that generate more and more cash. If you go throughout life as a net buyer, you will typically do very well in life. There's a reason why Warren Buffett says his favorite holding period is forever. He likes to buy wonderful businesses at fair prices that generate great returns, and he holds them forever. And they produce and they produce, they produce. If you just marginally shift your mindset to where people think, oh, I'm going to buy Bitcoin because it can go up. If you just really understand, why are you fundamentally making that purchase? Because you have a friend of yours or somebody on the subway you saw, or you saw something on the news that the price just reached a record high, so you think for some reason that's justification as to why you should go out and just willy-nilly throw money away and speculate that that money's going to continue to go up? Well, what happens when somebody ultimately decides not to buy that from you, right? Because that happens, especially with cryptocurrencies. They're extremely volatile. If you're fundamentally hoping that somebody's just going to pay more money for it than you did, at some point that gives way. And it's happened all throughout human history. The first bubble you could look back was the tulip bubble in the Netherlands 500 years ago or whatever that was. People just thought these prices would just keep going up, going up, going up, and they bid them like crazy until the bubble popped and people lost their entire fortunes. But if you really think about it, why the hell would you pay exorbitant amounts of money for a tulip? Especially something that's going to wither and die ultimately, but it doesn't produce anything. Versus they could have taken all that money, bought a farm, bought rental properties, bought something that's durable, that's going to stay there and generate and generate and generate for years on end. Anyway, I suggest giving it a thought because it's how I've been able to retire in my early 20s, and I don't need to really work anymore. I could choose to just lay in my bed all day if I want because I own assets that produce for me while I'm sleeping. I don't need to constantly work for it. Now, you might be thinking, okay, now I have a general idea of where I should be investing my money, but how do I get money to begin with? Well, if you've watched any of my videos, there's no real surprise that I'm a huge proponent of sales. It is the highest paid profession on the planet. If you want to learn a little bit more about sales, you can click over here. I have a video about that on my channel. And again, I do want to remind people you could contact me for free if you have any questions, if you have any ideas, if you just want to just run something by me. My information is in the description of the video. You could call me, email me, text me. If there's anything you want to run by me, I'm happy to help. But anyway, thank you for tuning in, and we'll see you next week.